There is a moment that every trader knows, even if they never speak it out loud. It is 2 in the morning, the charts are still glowing on the screen, and the account balance has dropped again. The hands are steady, but the mind is not. Somewhere between the first winning trade and this exact second, something changed. The plan that once felt so clear has dissolved into a blur of impulsive clicks, broken rules, and quiet desperation. This is not a story about bad strategies. This is not a story about missing indicators, or the wrong broker, or the wrong market. This is a story about the 7 quiet enemies that live inside every trader. The ones that never show up on a chart, but decide, more than anything else, whether a person walks away from this business broke or free. Most traders believe they are fighting the market. They are not. They are fighting themselves, and until that war is understood, no amount of technical skill will save them. One decision, one click, one destroyed account. That is how fast it happens. This audiobook is for educational purposes only and should not be considered financial advice. Always do your own research and manage risk responsibly. And tonight we walk through 7 psychological traps that keep otherwise intelligent, hardworking people poor, not because they lack knowledge, but because they lack mastery over their own mind. The first sin is overtrading, and it disguises itself as ambition. A trader wakes up, opens the charts, and instead of waiting for one clean setup, they see potential everywhere. Every candle looks like an opportunity. Every pair seems to be moving somewhere. This is the mind confusing motion with progress. Jesse Livermore understood this a century ago when he said that money is made by sitting, not trading, and yet almost nobody actually sits. The urge to overtrade comes from a deep discomfort with stillness. Doing nothing feels like losing, even when doing nothing is the position with the highest expected value. Consider a Forex trader watching XAUUSD during a quiet Asian session. There is no clear structure, no liquidity sweep, nothing resembling a valid smart money concepts setup. Yet the trader enters 5 micro trades just to feel active. And by the time London opens with a real opportunity, the account is already down and the mind is already rattled. The same pattern shows up brutally in gold. XAUUSD can move $15 in a single hour during high-impact news. And a trader who has already taken 8 trades before the New York session even begins is no longer trading a strategy. They are chasing dopamine. Professional traders solve this not through willpower alone, but through structure. They set a maximum number of trades per day, sometimes as low as 1 or 2, and once that number is hit, the platform closes, not metaphorically, but literally. The market rewards patience disguised as inactivity, far more than it rewards effort disguised as busyness. The second sin is revenge trading, and this is where the emotional damage becomes visible almost instantly. A trade goes wrong. The loss stings not just financially, but personally, as if the market has insulted the trader directly. And in that moment, logic disappears and something older takes over. An ancient instinct that says damage must be repaired immediately, that the account must be made whole right now, this very candle. Picture a Bitcoin trader who shorts BTCUSD expecting a rejection at resistance, only to get stopped out by a sudden liquidity grab to the upside. Instead of stepping back, they immediately double the position size and short again, this time without a stop loss, telling themselves the market simply cannot go higher. It does, and that is where everything changed. There was a trader named in no story but familiar to every one of us. A man who had built a small account over 4 disciplined months, watching it grow from $3,000 to nearly $9,000 through nothing but patience and one clean setup at a time. One evening, a trade he had trusted completely got swept by a single spike on gold, a wick that lasted less than a minute, stopping him out just before the market reversed exactly as he had predicted. Something in him snapped. He did not walk away. He entered again, bigger, then again, bigger still, chasing not a setup anymore, but the injustice of it all. By midnight, the $9,000 was gone, and so was something else, the quiet confidence he had spent 4 months building. He did not lose that account to the market. He lost it to a version of himself he had never met before that night. The solution professional traders use is almost mechanical in its simplicity, and that is precisely why it works. After any loss beyond a predetermined threshold, they enforce a mandatory cooling period, sometimes 15 minutes, sometimes the rest of the day, during which no new trade can be opened, no matter how obvious the next setup appears. It is not about suppressing the anger. It is about refusing to let the anger hold the mouse. The third sin is fear of pulling the trigger, and this one is quieter but just as costly, because it does not show up as a loss on the statement. It shows up as an opportunity that was never taken. A trader studies the chart for hours, identifies a textbook order block, watches price sweep liquidity exactly as expected, sees every confirmation align, and then freezes. The finger hovers over the buy button and does not press it. Moments later, the trade runs perfectly in the anticipated direction, and the trader is left staring at a chart that behaved exactly as predicted while their account remains untouched by the profit. Prospect theory explains this precisely, showing that human beings feel the sting of a loss almost twice as intensely as they feel the pleasure of an equivalent gain. And after enough losses, the brain starts avoiding the action itself rather than avoiding bad setups. This shows up constantly in gold trading, where XAUUSD's volatility can be so sharp that a trader who has recently stopped out on a valid setup becomes paralyzed the next time price approaches a similar zone, even though the technical picture is stronger the second time. Ed Seykota used to say that everyone gets what they want from the market, and for many traders what they unconsciously want is safety from further pain, even if that safety costs them every future win. Professional traders often pre-plan every entry the night before, writing down the exact price, the exact stop, and the exact target, so that when the moment arrives there is nothing left to decide, only an order to execute. The trigger is pulled not by courage in the moment, but by a commitment made in a calmer hour. The fourth sin is greed. And this is perhaps the most seductive of all 7, because it wears the mask of confidence. A trade goes well. The position is up nicely, the original target has been hit, and instead of closing, the trader thinks just a little more, convincing themselves this is the one trade that will finally change everything. Paul Tudor Jones built his entire career around defense first, famously stating that the secret to being successful is defense, not offense. Yet greed convinces traders that this particular trade is the exception, where offense should rule. A little more, just a little more. That whisper has ended more good trades than any bad strategy ever could. Consider a trader in a prop firm challenge who is up 8% for the month, with the profit target already reached. Instead of stopping, they take one more aggressive Bitcoin trade with oversized leverage, reasoning that hitting the target early simply means there is room for more. That single trade reverses hard, wipes out the entire month's progress, and triggers the daily drawdown limit, ending the evaluation instantly. There was a young trader who had finally passed her first funded challenge after 3 failed attempts. 2 months of discipline finally paying off, sitting at a comfortable 7% gain with days left on the evaluation. She told herself she would stop trading for the week, protect the target, and let the account clear. But gold started moving beautifully that afternoon, and greed whispered that one more trade would not hurt, that she had earned the right to push further. She took it without her usual risk plan, oversized, confident, certain. The move reversed within the hour. The account breached its daily loss limit before the candle even closed, and the challenge she had worked 2 months for ended in 11 minutes of impatience dressed up as ambition. The professional antidote to greed is almost boringly simple, and that simplicity is the entire point. Winning trades are scaled out in predetermined portions. A third closed at the first target, a third at the second, and the final portion left to run with a trailing stop that locks in profit automatically. This removed the emotional negotiation entirely, because the plan was written before the greed had a chance to speak. The fifth sin is a lack of patience, and though it sounds similar to overtrading, it is a distinct wound because it strikes even disciplined traders who have already entered a correct position. The setup was valid, the entry was clean, the analysis was sound, and yet the trader cannot sit still while the trade develops. They watch every tick, they refresh the chart every few seconds, and the moment price stalls or pulls back slightly, panic convinces them to exit early, locking in a fraction of the available profit. Ray Dalio often spoke about the importance of thinking in probabilities across time rather than reacting to each individual moment. Yet impatience collapses that long view into a frantic obsession with the present second. This is devastatingly common in Forex swing trades, where a trader correctly identifies a daily time frame order block on BTCUSD, enters with proper structure, and then closes the position 8 hours later during a minor retracement, only to watch the pair continue exactly as originally planned for another 2 days, capturing 3 times the profit that was abandoned. Patience is not passive waiting, it is active trust in a plan that was built with a clear head rather than in a triggered one. Many step away from the screen entirely once a trade is placed, setting alerts at key levels instead of watching price move in real time, because the simple act of not watching removes the temptation to intervene emotionally in a process that requires time to unfold. The trade does not need supervision. It needs the space that was already built into the plan before it was ever executed. The sixth sin is breaking risk management rules, and this is the one that turns survivable mistakes into account-ending catastrophes. Every other sin on this list causes damage, but risk management is the final wall that determines whether that damage is a bruise or a death blow. A trader who normally risks 1% per position suddenly decides, just this once, to risk 5% because the setup feels unusually certain. Certainty is a feeling, not a fact, and the market has no obligation to honor anyone's confidence. Just this once. Those 3 words have ended more accounts than every bad strategy combined. Picture a trader during the volatility of a major Federal Reserve announcement, holding a gold position with a stop loss that was quietly moved further away because the trader did not want to be stopped out before the anticipated move occurred. Price spikes through both the original stop and the moved one, and what should have been a contained 1% loss becomes an 8% account destruction in a matter of seconds. This mirrors on a smaller and more personal scale exactly what happened institutionally during events like Black Monday in 1987, when position size for calm markets met a level of volatility nobody had modeled for, and portfolios that seemed conservative one afternoon were catastrophically exposed by the next morning. There was a trader who had followed his risk rules faithfully for nearly a year, never risking more than 1%, slowly compounding a small account into something he was genuinely proud of. On the night of a major interest rate decision, he convinced himself that this particular trade was different, that the setup was too obvious to risk only his usual amount. He widened his stop, tripled his size, and told himself he was simply being smart about a rare opportunity. The announcement came. Gold spiked violently in the wrong direction, and his stop, now far too wide, gave the market room to erase 11 months of disciplined growth in under 4 minutes. He did not lose to bad luck. He lost to the one night he decided the rules no longer applied to him. The professional solution here is unemotional and mechanical, almost to the point of feeling rigid, and that rigidity is exactly its strength. Stop losses are placed the moment a trade is entered, and are never moved except to reduce risk, never to increase it. Position sizing is calculated before analysis even begins, so that the trader never has to make a risk decision while emotionally invested in a specific outcome. The seventh and final sin is the refusal to accept losses. And in many ways, this is the sin that all the others eventually feed into. A trade moves against the plan, the stop-loss level is reached, and instead of exiting, the trader removes the stop entirely, telling themselves the market will surely reverse. This is not analysis anymore. This is hope wearing the costume of strategy. Identity shift plays a brutal role here, because for many traders, accepting a loss does not feel like closing a position. It feels like admitting personal failure, and the ego will fight ferociously to avoid that admission, even at the cost of the entire account. This is visible with painful clarity in leveraged Bitcoin positions, where a trader holding a losing long position through a 10% drawdown convinces themselves that closing now would make the loss real. As if the loss were not already real the moment price crossed below their entry. Not real yet. That is the lie the mind tells, right before the loss becomes permanent. Prop firm traders face an especially unforgiving version of this sin, because most funded accounts include a maximum drawdown rule that ends the account entirely if breached, meaning a single unaccepted loss held out of stubbornness rather than strategy can terminate months of qualification work in one session. The professionals who last in this business have made peace with a truth that beginners resist for years, which is that losing is not the opposite of winning, it is a required cost of doing business. The same way rent is a required cost of running a store. They do not celebrate losses, but they do not fight them either. They accept the exit at the predetermined level, log the trade, and move to the next opportunity with a clear head, because the alternative, refusing to accept the loss, guarantees a far larger one waiting just beyond the horizon. What becomes clear once all 7 sins are laid side by side is that none of them are separate problems, requiring 7 separate solutions. They are all branches of the same root, and that root is the trader's relationship with discomfort itself. Overtrading is discomfort with stillness. Revenge trading is discomfort with injustice. Fear of pulling the trigger is discomfort with risk. Greed is discomfort with enough. And patience is discomfort with time. Broken risk rules are discomfort with limitation. And refusal to accept losses is discomfort with truth. Every single one of these traps offers the same false promise. The promise that if the trader just pushes a little harder, breaks the rule just this once, avoids the pain just for now, everything will finally feel okay. And every single time that promise is a lie, because the market does not negotiate with emotional needs. It simply moves, indifferent to whoever is watching it. There is a version of you that already knows all of this. That version has felt the shame of overtrading at 2 in the morning. felt the rage of revenge trading after an unfair stop hunt, felt the paralysis of a perfect setup left untaken, felt the seduction of one more trade, the restlessness of a good position closed too early, the arrogance of an oversized bet, and the denial of a loss left open far too long. That version is not weak. That version is human. Every trader who has ever made real money in these markets has walked through the exact same fire, has broken these same rules, has lost sleep over these same mistakes, and somehow kept coming back. The difference between the trader who quits broken and the trader who becomes quietly, consistently wealthy was never talent. It was never a secret indicator, never a perfect strategy that never loses, never a mentor who unlocked some hidden truth the rest of the world missed. It was the decision made again and again on ordinary days when no one was watching, to choose the plan over the panic, to choose the process over the pride, to choose the long game over the next candle. Somewhere out there tonight, a trader is staring at a screen, finger hovering over a button they know they should not press. And somewhere else, another trader is closing their laptop after a loss, walking away instead of doubling down, feeling nothing like a hero, feeling instead quiet, disciplined, almost boring. That second trader is the one who survives long enough to become dangerous in this business. Not because the market got easier, not because the losses stopped coming, but because they finally stopped fighting themselves long enough to let their edge work. The market will still be here tomorrow, indifferent as always, ready to reward whoever finally stops sabotaging their own hands. Discipline is not the price you pay to become a successful trader. Discipline is what successful trading actually looks like from the inside. Quiet, repetitive, almost invisible to everyone except the person living it. And one day, months or years from now, you will look back at this exact version of yourself, the one struggling right now with one of these 7 sins, and you will recognize it not as your weakness, but as the beginning of everything that changed. If this audiobook changed the way you think about trading, subscribe to the Trading Library and join us for the next lesson in mastering the trader's mind. Carry this with you the next time the charts are open and the emotions rise, because the trade that matters most is never the one on your screen. It is the one happening quietly right now inside your own mind.